This is the state of the market for March 18, 2016. So today I'm going to start by looking at the Dow Jones Index. And I always look at ETFs because they're tradable. So we're going to use IYY, which is the ETF for the Dow Jones. Now the Dow Jones has 30 stocks in it. And typically you're not going to see it outperform the SPY. You're not going to see it outperform the S&P 500. People generally are buying Dow stocks for investments. They're value stocks for the most part. They're buy and hold. They're not trading stocks. And that's something you see here. You see how the candlesticks are not so fluid like you would see in the SPY. Let's take a look at the SPY real quickly. SPY flows together really well. The Dow Jones doesn't, because it's not full of trading stocks, except for maybe Apple and a couple like that. But overall, the Dow Jones shouldn't really outperform the SPY, but it has. And you got to ask why. Generally, if it outperforms the SPY, something weird is going on. And in the recent case of what we've been seeing, where money has been pumped into the Dow Jones mysteriously, is probably due to central banks and governments' intervention. This is Dow Jones for the day, and this is the Dow Jones for the month. Now, what's interesting is when you look at the Dow Jones for the quarter. What we see from the beginning of the quarter to this low point here is a 15% drop in the Dow Jones Index. That's a drop from value stocks. That's really concerning for any investor because it means that people are ditching value stocks. In the entire history of the Dow Jones, we have never seen a quarter where the Dow Jones has dipped over, I think, 12% or so, and then come back. So this would make, if we happen to reach that 105 point by the end of March, that would be the most significant comeback in the history of the Dow Jones Index. Now, it's certainly not likely. It hasn't happened in the past, so if you want to just play pure statistics, there's a 0% chance of that happening. But the possibility that now we're looking at a very different market is present. And the reason the present time could be very different from the past is that we have all four of the largest banks in the world intervening in the stock market in some way. For example, the Bank of Japan is using negative interest rates to push money out of bank accounts, out of savings, out of bonds, and into the stock market. This is all happened in the past 2 months. The European Central Bank has engaged in 80 billion euros of quantitative easing. So that's stimulus, and that is 700 more times than expected of stimulus. You got the Fed, who's stepped away from higher interest rates, and you got the People's Republic of China's central bank, which is devaluing the yuan. So you got all these four banks intervening, which has pumped up the stock market from a previous 15% drop. So we might actually see the Dow Jones make that 15% record comeback. What we're looking at is really a Ponzi scheme in play. If you wanted to, if you saw this and you were thinking buy the dip, you probably would have been right, but not because of fundamental reasons, and not really because of technical reasons. You'd be right because you are aware of the Ponzi scheme that's happening. The banks pump up the stocks. They hope that investors follow. They hope that traders follow. They hope that hedge funds follow. If they do, then good. They can make money off that, and then investors can follow, and then traders can follow, and everybody can follow, and you got this huge artificially inflated bubble in the stock market that eventually will crash, but we don't know when. As long as the banks are keeping it on life support, it might just keep going up. You don't know. I'm more akin to playing the fundamentals. I'm more akin to being short, because eventually when it does happen, that will make me rich. Instead of playing this hopeful game that the life support system will continue. Now, at the current time, we're seeing the Dow Jones Index being overbought. Now, whether that overbought signal represents a short or a sell signal, we're not sure, because the last one, here's one, you see how the green line crosses below the red line? That's a sell signal or a short signal for most things. But in the past two instances, that has not occurred in the Dow Jones Index, and that's clearly because of intervention. Previously it worked. Here it worked, fell down. Here it worked, fell down. The last two symbols have not worked due to intervention. The next symbol we get, which will probably be very soon, will tell us whether that intervention will hold, because all four banks have already done their intervening. Now there's really nothing left until perhaps April, perhaps next quarter. So this next symbol is going to be the make or break of the Dow Jones Index and the stock market as a whole. I want to look at the FXY. I'm going to switch back to the 30 days. FXY is representative of the yen, the strength of the yen versus the dollar. So it can also tell you a bit about the dollar. But in general, when the yen goes up, it's either because the dollar is falling, or it's because people are getting worried about the prospects of the stock market. The yen has always been a safe currency. When people are afraid of economic collapse or recession, they generally go to commodities such as gold, or they go into yen, or they go into bonds. And as you can see today, the yen is up. And as of today, we've got a up gap. Now this is an area gap. If you're familiar with gap trading, this is an area gap just based on price alone. It hasn't moved us out of previous price range. And if we want to look at the volume, we're going to see that the volume is not significantly high, which means that, see how the volume here is not higher than any of these previous volumes? This implies that we've got an area gap. Now, whether that's tradable or not, I'll check that right now actually. Perhaps we could trade this and expect a yen bounce back, but this would be a pure technical trade. As to whether the yen is up because of investors being afraid of the market, or just because of the devaluation of the yen versus the dollar, it's questionable, but I'm going to go with the latter. It's probably just pure devaluation. And we can check that by looking at the dollar. You look at UUP, you can see that the dollar has fallen. So we've got this same gap here, and it's very clear now that it's a dollar problem, not a yen problem. You can see what I'm doing, yen, FXY. So is this tradable or not? Well, let's look at, we've got two positions. We could go long on the UUP, or we could go short on the FXY. I would say you probably want to go short on FXY because it's, that way you can use a put and you can probably get a bit more money because it's at a higher value. UUP, you could get up perhaps $1. Neither of these are very high reward plays, but we'll check them anyway. Let's check the FXY. Why not? So I'm going to run a quick test here on the FXY. Let's assume that, because we're looking at an up gap and we're going to go short, let's assume that we trade the FXY. Playing short, and this is not options, this is just purely shorting stock. But if this is profitable, then options will be profitable as well for the most part. Let's take a quick look at how this trading strategy does, and then we can look at the UUP as well. Running. But for this short strategy, we're looking at a very quick trade, perhaps a swing trade within a week. And for the UUP, we would do the same thing, maybe a week or longer. So I'm going to queue that code up while this is running. Well, there we go. Alright, so this would not be a profitable strategy. You don't want to go short on the FXY. Let's try the other one. Down gaps long, betting that the UUP gap that we saw will fill. Let's see how that works. While I run that, let's look at the gap again, because the volume there might be a bit different. I don't think it will, but let's take a look at the UUP's gap and see, because we're actually outside of the trading region, this might be a breakaway gap. The candlesticks imply that it's not, but let's take a quick look at the volume. The volume is really not that high, especially compared to yesterday. So I'm going to say that this is probably an area gap. I'm going to take a look at the result of that algorithm on this trade and see if that's profitable. But if the FXY one's not profitable, this one probably won't be profitable as well. So take a quick look. And we actually don't have any trades. I guess we didn't look far back enough. We only went back to 2010. But I'm just going to say stay away anyway. Forget it. Let's move on to look at the general market, the SPY again. So over the past month, the SPY has gone up quite a bit. Pretty much the same as the Dow Jones. Same pattern here. Today, what happened with the SPY was a 0.67% increase. It didn't really hold at the very end. This is a pretty rare situation. The SPY opened downward because of future contracts, but then I'm guessing money was pumped in. I'm guessing this is manipulation, because it stayed at this overbought region for quite a while, but it couldn't hold. So at the very end, it jumped down, and you might even look at the VIX for that reason. So there you go. The volatility of the market went downward, everything started to stabilize, and at the very end it popped up. So I don't know what was happening there. Perhaps a lot of people knew that the market was going to go up and they decided to get out at the last moment for the SPY, but that didn't really happen with the Dow Jones, did it? So why is this important? Well, although today we did see a slight gain of 1% in the SPY, we didn't see a gain in the major stocks. And by the way, the QQQ is not really up, is it? Yeah, it's pretty much flat. And that's kind of strange, because the QQQ usually moves faster and harder than the SPY. So if we have a 1% gain in the SPY, we'll usually see like a 1.5% gain in the QQQs. Now, this pattern is similar, but we saw the SPY move upward and we saw the QQQ move pretty much sideways. This is a rare occurrence, and it could imply that people are just pumping money into value stocks and not really caring about the stocks that most investors go to for growth. And you can check this. You can check this by looking at the most shorted stocks, and you can look at the FANG stocks as well. So, for example, here's the SPY. SPY was up. Let's say it's up 0.66%, a third of a percentage, 2/3 of a percentage. What about Facebook, which is a major growth stock? Facebook is down 1%. What about Amazon? Amazon is down 3%. What about Google? Google is up about half of what the SPY went up. So why was the SPY going up, but all of these growth stocks going down? Well, I'm thinking that we're looking at probably a short squeeze on the lower end of the stock spectrum. And I actually checked this. If you go and look at the most shorted ETFs, you see that pretty much all of these went up much more than the SPY went up. So take a look at SMH, for example. SMH went up more than the SPY, basically the same as the SPY, so it's not really impressive, is it? But XRT, XBI, I'm sure these went up higher. XBI up, nope. XRT up a bit more. So today maybe is not that special, but let's compare them to the SPY overall. What do we look? Let's look at one that's popular actually, but heavily shorted. Why not look at the real estate one, IYR? Let's look at the dailies first. IYR, that's up almost 1.5%, and compare that over a monthly time, you see that the rise is a lot stronger than it was in the SPY, which is probably a short squeeze. So you will usually, when you see such a rally in the stock market, you usually want to look at whether that rally is in those growth stocks like Facebook, or whether it's in those really heavily shorted stocks, in which case it means hedge funds and investors are covering their shorts because they're afraid of the money flowing into the stock market in general, and they're not really looking at the fundamentals. Investors putting their money into Facebook or into Apple are looking at the fundamentals more so than the people who are short on, for example, penny stocks or these heavily shorted ETFs. Let's look at a couple sectors that have done really well in this bear market. We've got biotech, and we've got it doesn't really show us. We can't go past 200 days. Oh, we can. All right. So let's just say the bull market has lasted for 5 years. This has done really well, but it looks like this bubble is popping. And well, that's biotech, and then we've got healthcare. Healthcare looks pretty much the same. It looks like we got two bubbles that are popping. Compare this to the SPY, which is up now, and then QQQ, which is up now. These two, the IBB, which is the biotech, and the XLV, are mysteriously down when the entire market is up. So while the bull market bolstered these two sectors more than anything, these two sectors are the ones that are down the most in spite of money being pumped in. Again, we're not looking at a fundamental rally anymore. So here, these were fundamentals and speculation. Now people are getting out. They're taking their money out of these speculative positions, even though these positions were the most profitable. If I were going to invest or put my money in the stock market at the moment, I'd probably go with these ETFs that are looking like popped bubbles, because what we're seeing is probably a pullback due to fear of real economic and fundamental concerns that have unfairly hurt these sectors that have fundamentally done well. Let's take a look at bonds. IEF. We don't want to look that far out. So bonds are a bit down, and bonds are pretty much a safe investment when the economy or the stock market hits a recession. So if bonds are up, it generally represents people taking their money out of the stock market. And today we saw bonds trend sideways while the stock market went up, which is a bit interesting. And overall, the bonds are basically sideways for the month. So you got two catalysts pushing bonds up and down. One is people putting their money into bonds because of fear of stock market crash. Another is governments pumping money into bonds because of quantitative easing. And then in the downward direction, you have people who are moving out of bonds, moving their money out of bonds into stocks because stocks will make more money. And you also have the interest rates that have been on a hold. The Fed has decided not to raise those rates. So instead of keeping your money in a bank, well, bonds is probably a safer alternative. Again, compare bonds to the dollar. The dollar has fallen while bonds have stayed the same. What about gold and silver? Gold is doing great. I think this is a record quarter for gold. But today, gold is a bit down. However, curiously, silver is up. Why? I'm not really sure. Maybe gold is a bit overbought. The stochastics don't say that it's overbought. Oh wait, that's silver. Well, the stochastics don't say gold is overbought. So maybe gold is overbought in the mind of the investor, and people are moving into silver as well. I'm not really sure. Looks like we might have just a weird day with an area gap, and let's check again if this is an area gap, and then check that trading methodology. I wouldn't want to bet against silver at this time, and there you go, you got a really high volume. So that might actually be a breakaway gap. I would say ignore this gap for the moment, treat it as a breakaway gap just based on volume alone, in which case if it's a breakaway gap, we're going to see silver move further upward. It'll probably lag behind gold in a sense, but for now I'd stay away from silver to see if this gap fills or not. As you can see, we've had gaps like this before that appear to be area gaps and then end up filling. But the point of today is silver's up, gold's down. Why? I'm not so sure. If you have an idea, let me know. One of the weirdest things about this market, though, is earnings expectations of the S&P 500 stocks are really bad. They're getting worse. I saw this article a couple days ago, March 15, so it's 2 days ago. This guy says, something fishy is happening. The numbers are getting fudged. Companies are hiding things. It's all an illusion. 4 different links on articles on those topics. And he states, here's his point, only one sector will see EPS growth this year. All the other sectors will have their EPS growth slashed. So this is what has been happening for the past actually 2 years now, but it's getting a bit out of hand. So the earnings momentum has stopped growing at around July. And if you remember, around October last year, we did have a market correction, and that's what we're seeing. We saw a bump, and then the expectations go down. Now we're seeing a bump, and now the expectations are going down. So I think a correction is probably overdue. We really don't have any positive earnings growth here to sustain the market fundamentally. So then again, why is the SPY growing? Why is the SPY going up when earnings momentum is still heading down? Well, all you can say is it's intervention. There's no fundamental reason behind it at all. So one day it's going to head down. The SPY has to head down. There's nothing to support it. Now, on this note, let's say you want to be long on the market. Here's an interesting point. Only the insurance sector is expected to see EPS growth. So that makes you think maybe you should get into the insurance sector. Well, if you want to, I can recommend a couple interesting plays on this. It's not really a recommendation at all. It's just most people don't know of these ETFs. So the big insurance ETFs are KIE, which is going up and will probably continue to go up if the EPS of the holdings are going up as well. And then IAK. I honestly don't know the difference between these two ETFs. You're going to have to go and look into the holdings themselves. But according to earnings estimates, these ones should be good. These ones should be okay. And if you think that the market is going to continue growing with this government intervention, then these are probably the safest places to put your money. And if you want to just be hedged, if you're already if you're already short on the market and you want to hedge with some long positions, these will work as well. And a final one would be actually finding individual insurance companies. And I like Met. The reason I like Met at the moment is because MetLife, you probably have heard of this insurance company. MetLife is actually a pretty interesting pick at the moment because MetLife sees 70% of its revenue come from Japan. It's huge in Japan, not so huge in the US. So 70% of its revenue comes in yen. And if the yen continues to strengthen, that's going to resolve the forex issues of Met. So Met makes a lot of money in yen, brings it back to the US, and gets hurt by the foreign exchange. But if the yen is strengthening, then and the EPS of Met is strengthening, then what you got is a double whammy of bull catalysts, and Met should continue upward. So this is actually a pretty good pick for anyone who wants to be less diversified in the insurance industry. Remember, less diversification means more risk, but also more reward. So if you already have a pretty diversified portfolio and you're looking to add an insurance stock, I recommend going with Met. If this video has been helpful helpful to you, please like it and subscribe, and leave any comments below. I'll continue doing these state of the markets as long as I see interest and enough views. So if you have any questions, please leave them in the comment section below, or if you have any requests for videos, leave them in the comment section below, and I'll be sure to get to them.